The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick. These are your headlines. US markets take the Fed minutes in its stride after a readout of the committee's last policy decision shows greater division over that jumbo 50 basis point cut than initially thought. Whiplash. Chinese stocks extend gains amid heavy trading volumes as the central bank kicks off its new 500 billion yuan liquidity tool.
Germany downgrading its growth outlook, now forecasting a second straight year of recession. That's for the first time in over 20 years. The Economy Minister Robert Habeck says the government is tackling the challenges.
Dass die Lage zwar insgesamt,
although the situation is not satisfactory overall, we can certainly see progress being made in tackling these problems.
Airbus deliveries hitting a snag, dropping 9% in September. But the European plane maker backs itself in a fourth quarter sprint to hit its full-year target. And Hurricane Milton makes landfall, unleashing life-threatening winds and knocking out power for more than 2 million people as the now Category 2 storm barrels over the Florida Panhandle.
A very confident day for US markets stateside, given that we are still counting down to more data today in the form of the inflation report. But we had record levels again on the Dow and the S&P 500, both of those major markets grinding to fresh peaks. So 1% pop on the Dow, 0.7 up on the S&P 500. For the Nasdaq in the mix, that's 0.6%. Don't forget, we've been front-loaded in terms of some of those tech gains so far this week. A lot of heavy lifting out of the sector. It is also on pace for its fifth positive week. So the Nasdaq certainly also eking out gains, but about 2% off its record highs. But big movers in session, the likes of Apple in the technology universe, Broadcom, the semiconductor. So there were some tech names in play yesterday, but in terms of sectors, it was healthcare leading the charge up to the tune of about 1%. Somewhat left behind was the utilities trade. That was the laggard in session yesterday. But the all-important countdown to the CPI today, that's what the market is focused on to see just whether we are getting back to the levels that many hope when it comes to inflation, in the context where we've had a wildcard labour report that showed still some strength in that labour market. Let me take you to Treasuries and what we're seeing on this board. We are through 4% now on the 2-year, even with the red arrow this morning. So we've climbed to that level. We're 4.07. So very small spread still between the short and the long end as we see that 4% handle. I want to take you to the dollar. That yield story is providing some strength in the dollar trade. And in fact, you're seeing it on dollar yen. That is the highest level since about August that we've got on that rate, 149.5 roughly where we're trading. Elsewhere, we're trying to claw back some territories, you can see, against the greenback morning session. Euro dollar having some success, 109.41. Cable, fairly flat morning session, 130.72. Elsewhere, WTI and Brent, we're still all closely watching the geopolitics in the Middle East. That's put a premium back into some of these prices. We're just off the 74 handle on WTI. That is a bounce of close to 1%, and similar ranges on Brent, 77.23 where we're trading. Gold prices, a bit more strength the morning session where we have been in a bit of a sideways consolidating pattern, 2614 in recent weeks. So that is a bounce of about 0.25%. To the Asian markets, well, it's still a roller coaster, isn't it? We're going up, we're going down, we're going back up the next minute. And for those Chinese stocks, you can see securing more gains today. 3% up for the Shanghai market. Hong Kong 4.6%. But insight now, this press conference on the weekend, and just whether the market does feel like it's getting more from authorities this time round after a disappointing press conference early in the week. More normal ranges, as you can see, bookending this Asian market from South Korea to Japan. Modest upbeat action on those indices, Steve.
Yeah, thanks, Karen. I think you've epitomised the concerns and the excitement over what may happen on Saturday rather well. The latest rollercoaster session in the greater Chinese markets comes as the PBOC launches its 500 billion yuan swap facility. Sam joins us with more. Sam, I don't know whether to be excited about Saturday or not. And looking at a lot of the copy out there, I think everyone's in the same boat.
Yes, I think the markets are sort of perhaps setting themselves up for a bit of disappointment if they are certainly hoping to get that quantified fiscal package, because the Ministry of Finance is holding this press conference on Saturday, and they are likely to unveil some steps as far as fiscal policy. But that number that everybody's sort of hanging out for, whether it's 2 to 10 trillion yuan, particularly worth of government bonds to help out some of the consumption, the demand side of the equation with regards to household stipends and also local government debt. As far as the mechanics are concerned and the timing, the MOF does need to get that signed off by the Standing Committee at National People's Congress, which will be meeting at the end of the month. And so that is when it's more likely that we're going to be getting any sort of concrete magic number, because, of course, we are anticipating to hear from the Ministry of Finance. So that was sort of the missing link here as far as substance was concerned. But a lot of the economists are suggesting that, as I mentioned, we're not likely to get any sort of big number as to what they're likely to throw at the economy. So we do have to wait and see in the coming weeks as to what they might say about that, given the NPC at the end of the month. But then, you did mention that the PBOC came out with this sort of surprise announcement this morning. This was the piece of the stimulus package that they had announced prior to the break that seemed to have got the markets rather excited. The feeling in the market is that it's somewhat maybe easier to help out confidence in the stock market than it is in the housing sector. So what they've been suggesting is that they would be allowing some of these funds, these financial institutions, to tap the PBOC as part of a sort of swap deal so that they could buy stocks. And this is likely to help liquidity in the market. And no doubt some of the tech stocks are likely to benefit from that. So that seemed to, in the absence of any more substance, details and specifics from the fiscal side of the equation, continue to put the wind back in the sails of the markets again today. So the volatility, as I've been saying all week, is expected to continue as we get into that Saturday press conference. But not to mention, we also have the inflation numbers out on Sunday. So traders will be getting their feet back under the desk on Monday, reacting to both of those things, as well as looking ahead to the trade, the export and import figures on Monday, guys. I'll send things back to you.
Yeah, what a busy old weekend we all have looking at China. Thank you very much indeed for that, Sam. Much appreciated. Right, Fed officials were split. Oh, I hope they were. I hope everyone's not saying the same thing. It's kind of a good thing when you have different views. Anyway, Fed officials were split on whether to implement September's jumbo half-point cut at their last meeting, according to the latest FOMC minutes, but a substantial majority supported it. We kind of know that, don't we? Because it was only Bowman who was a dissenter. Anyway, the minutes appear to back the growing consensus that the outcome of November's meeting hangs in the balance. Investors have repositioned their bets from a 1 in 3 chance of another 50 basis point cut to a 1 in 5 chance of a hole. But let's be brutally honest, no one knew until kind of the nods and the winks the week before last time round that it was the speed with which 50 moved up and 25 moved down was quite extraordinary. So I'm not saying there was any leakage, but it just felt that people seemed to know. Anyway, Boston Fed President Susan Collins is clear that further adjustments will be likely needed. I don't know what that means. Her remarks echo those of her San Francisco colleague Mary Daly, who says she sees 1 or 2 more cuts this year. Thank you, Mary. Dallas Fed President Lori Logan said she'd been behind a half-point move in September, but wants smaller reductions ahead. Thank you too. Karen.
Well, this all ahead of today's important CPI release. It's expected to show price increases moderating on the month, with the annual inflation figure easing to 2.3%, according to Dow Jones estimates. Our US colleagues will get the first conversation with Chicago Fed President Austin Goolsbee after that data hits the tape. Don't miss that conversation coming up at 3 p.m. BST. Deval Joshi joins us now, Chief Strategist, BCA Research. Thank you very much for joining us. We are digesting the minutes. It didn't feel as though we had much in the way of forward guidance from here in those notes. What did you make of the information flow that we got from the minutes?
Well, I've actually just written a report called Is the Fed Asleep at the Wheel Again? Meaning that I think that it just doesn't seem right that the Fed should be doing aggressive rate cuts at a time when the economy is growing at over 3%, according to the latest Atlanta Fed GDP nowcast. And the reality is that although inflation has come down, I mean, a lot of the measures are still inconsistent with 2% inflation. So I think the minutes were kind of, when you sort of read them, that what they're saying is the balance of risks is sort of, if you like, equal between inflation and growth. But I think the markets maybe have sort of misinterpreted that in terms of the amount of rate cuts, certainly that were being priced in, and they've come back. But I still think the amount of easing that's priced in is a bit too aggressive for the state of the economy and the jobs market at the moment.
In terms of the language we had from the minutes, I mean, this was one line that caught my attention, that a few officials thought a smaller cut could signal a more predictable path of policy normalisation. So the fact they didn't go for the smaller cut that would have suggested predictable, does that mean they want to be unpredictable, that the Fed wants to keep the market on its toes?
I think that there was some sense that there was a bit of catch up because, there was an argument that they started a bit too late. In other words, they should have gone in July, so that the September meeting was a kind of, look, we're catching up for July. And maybe the ideal would have been 25 then, 25 now, and just going in 25. So that's one way of interpreting it. But, there was a point prior to the jobs report where there were more 50s priced in, and I just thought that doesn't seem right with where the state of the economy at the moment, and also wage inflation has cooled, but it's still running at around 4%, and I think that the target that you should be going for in terms of wage inflation is around 3% to be consistent with 2% price inflation, because that 1% is the productivity growth that you can assume. That's the sort of the last decade's average. I don't think you should assume more than that. So we're still short of that, that 3% target and wage inflation.
Darvel, I a huge sympathy. By the way, thank you. You're erudite as ever. I have a huge sympathy for what you're saying. But, and you start off with Karen saying, it just doesn't seem right. Are they asleep at the wheel again? And yes, I completely agree with you in some ways. But then the other part of my brain is saying, oh, hang on a second. If they keep rates constant while inflation is going down, actually the cost of money in real terms is going up. So what they are trying to do, maybe, if I'm being more sympathetic, is actually just keep pace with the declining inflation and not get behind the curve there, rather than trying to make things easier money-wise, i.e. if they kept rates where they were or only cut by 25 basis points or cut at a slower rate, then actually money's getting more expensive compared with inflation.
I mean, arithmetically, you're right. But if you think about it, we're talking about rates even now coming down by 100 basis points, one full percentage point over the next 6 months. And inflation isn't going to come down by that much, right? It might come down a little bit. So when you look at the magnitude of the two moves, that doesn't, it's still excessive, right? Even if you're saying in let's look at it in real terms, but even in real terms, you're seeing this big decline. And as I say, the economy is doing fine at the moment. And even the key metric that I'm looking at, I think the Fed's looking at, is the job vacancy rate. And the job vacancy rate has, came down, but it's sort of settling at too high a level. And that's the key metric. You want it to settle at around 4% or just above 4% vacancy rate. And now we're still sort of closer to 5%. Now, that doesn't sound like a lot, but that is still a big difference between inflation being at 2 and 2.5%, in my view anyway.
No, it's great. And that's why I love it. It's funny, if I was just saying to Karen off camera, that this debate shows that economics is a poor science in many ways. Darvel, the market always wants more than it gets, or certainly has done for a long time. It's been calling for more aggressive rate cuts for way ahead of the Fed pivot last November. So if you're right, and the Fed doesn't go as quickly as it has done, and is just going to have to kind of pull the handbrake on some of these expectations, and on its own dot plot for that matter as well, Do you think there's going to be market ramifications? Because I keep hearing about, there's financing, there's a wall of financing. People took advantage in 2020 of the cheap financing. Now they're going to have to roll it over. Are there ramifications really for the economy, for the markets of that slower rate cutting policy, which you're just tipping a nod to?
Yeah, I think there is. I mean, the important. I mean, there's a bit of good news here, which is, look, if they cut less than is priced in, it means the economy is doing fine generally. So that's actually good for profits. I don't think we should be worrying about a profits recession. So that's the good news. The bad news is that instead we should be worrying more about a valuation recession. So that's the way I'm putting it. Don't worry about profits, but maybe worry about valuation, simply because if rates don't come down as fast as being priced, then obviously yields are going to go up, and that's not good for valuation. So the way I'd sort of think about it is, look, the cyclical stocks that are sort of most exposed to profits, they should be okay. They've probably been sort of oversold, and that's the place you want to be maybe for the next few weeks or months. Whereas the sort of the richly valued stuff is probably at risk. So there's a sort of rotation argument that stems from this. And of course, for bonds, it means that short duration bonds could sell off a little bit further. And of course, Fed fund futures, the rates curve could sell off a little bit more if they do not deliver the rate cuts that are still priced in.
And Dhaval, thank you so much for joining us today on the back of the Fed Minutes and setting us up for CPI today. More data out. Dhaval Joshi with us, Chief Strategist, BCA Research. And you can find out more analysis of the latest FOMC minutes on the CNBC website. To some corporate news, sales at Givaudan rose 10% to just over 1.9 billion Swiss francs in the third quarter, marginally ahead of analyst expectations. The fragrance and flavour giant said it saw strength across all markets. This as the European chemical sector faces weaker demand. Steve.
Right, coming up on the show, Europe's largest economy stumbles. Well, it's expected to contract this year. We're going to break that down with Annetta. Plus Airbus. Now, we've heard the Boeing bad news, but now Airbus deliveries are actually dipping as the plane maker battles supply chain issues. We'll have the details next. And Italgas touts AI as the group targets digitalization-driven growth. We'll speak to CEO Paolo Gallo in an exclusive interview. We'll do that in 15 minutes' time. Does it matter if Germany is in recession or in expansion, if it's around the flat line? Does it change anything? Not to those of us who've been looking at the economy for a long time. Germany now expects its economy to contract by 0.2% in 2024. Well, quite frankly, it doesn't really matter if it's up 0.2 or down 0.2. It's still pretty awful compared to what they want to be. Anyway, it's down from the previous 0.3% growth. I suppose the markdown of 0.5% does matter. Now, it would mark a second straight year of contraction for the first time since 2003. Annetta, my point being, and you know this better than anyone, God, we've been talking about this for a long time. We've been talking about the structural problems. We've been talking about the lack of support, the too much regulation. We've been talking about the lack of capital investment. The fact that Habeck is pointing this out to us now is kind of like, and? I don't know, am I missing something?
Well, actually, you're very right, because he was in charge of he is still in charge of the economy in his ministry, and now is saying that, listen, there were so many years of no reforms, and there is such a need for structural reforms. That's why the German economy is really ailing at the brink. And of course, that it puts him in an awkward position, because he would have been the man who actually was in charge, or still is in charge, to turn things around. But he has done the opposite with his twist and turn when it comes to the energy policy, but also when it comes to regulation. That's one huge issue for the German economy. It's over-regulation, too much bureaucracy. And that, of course, prevents investment, because nobody wants to really invest a lot of money if they don't know how the rules will be in a couple of years. Because what we have seen in the past, or under this government, is that rules can get changed all of the sudden overnight. And of course, that prevents investment. And that is what we are seeing. CapEx, like investment in capital goods, is down by almost 7% year on year. And that is one of the major reasons for the weakness. Despite all that, the minister is showing some sort of confidence that things can get better next year. Perhaps we take a listen.
Dass die Lage zwar insgesamt,
although the situation is not satisfactory overall, we can certainly see progress being made in tackling these problems. So not everything that looks the same is the same. And I want to remind you where we come from high inflation and from the fact that people are actually getting poorer. We can now say that this task has been tackled.
So back in July, the government agreed on a so-called Growth Act, which means lower taxes, lower energy prices, also cutting down red tape. But the question is when this is going to get enacted, because given that there will be general elections next September at the latest, there's not much time because they already change in kind of election campaign mode. So essentially, this government, that's at least what business is thinking, has done a lot of bad to the economy. And there's much hope that the next one will actually come up with something like the Agenda 2010, like many years ago when Gerhard Schröder turned around the fortunes of Germany by a huge reform act.
Annetta, where does this leave ECB policy then? Because we were talking to Citi yesterday, to Lewis Costin, he was saying, look, there is a real argument that the ECB has over-tightened. Now as we see an economy that is not bouncing back and it's the core part of Europe, is there a view that there's more pressure on the ECB because of what is transpiring in Germany?
I'm not sure whether Germany puts more pressure on the ECB, but I think it's quite telling that the normally very hawkish Bundesbank president was stepping out in an interview earlier this week saying, yes, I'm very confident that there needs to be a rate cut. So that is unusual. And he was also saying that there's more to come. And that is like literally the same what Villeroy de Galhau, the French central bank governor, was saying. So yes, of course, the core of Europe needs lower rates. That's quite obvious because clearly the ECB, whether they have over-tightened or not, but they are, and they have a tendency to be late in tightening, and they are also having a tendency to be kind of reluctant and late in easing. And that is because the institution itself has less self-confidence than the Fed.
Yeah, I hear you. Look, I never want to not hear the word Schuldenbremse because I think it's a lovely word and I think Germans have the best words.
Oh,
but,
yes.
but having said that, if I want to see the German economy become what it was, then I do want to, excuse me, I'm getting emotional. I do want to see the end of Schuldenbremse. So is there a real important debate from Berlin to Frankfurt, from, I don't know, Hamburg to Bonn about getting rid of the debt brake and unleashing the power that Germany has?
Not really. I think that needs to start. It has started in the academic world, with for example, the Council of the Wise Men, as it is called, the Sachverständigenrat, which is advising the government about economic policy, or at least telling them what they should do. They're even saying and advocating that there needs to be a reform of the Schuldenbremse, the debt brake, because it does hinder investments, and what we need are investments. They should be exempt from the so-called schwarze Null, the zero black, so meaning no new debt in the balance sheet of the state. But as I said, the liberals are adamantly against that. What we could see is that the liberals, once they leave the government and they're no longer part of it, which is very likely for the next government, then there is more willingness to actually reopen that debate and that investments could be exempt from it, because this country needs investment everywhere, in schools, in infrastructure, roads, like literally everywhere. And it needs to have a thorough cut of red tape, because we are seeing it everywhere, from aviation to energy policy to as well normal bureaucracy for the chemical industry, like for the car industry. It's like everywhere, it's too much bureaucracy.
Yeah, I've just gone on to the top 10 German words, and Augenblick, one of my old favourites, is up at number 10. Number 3, another great one, Wanderlust. I love that one as well. And Zeitgeist comes in at number 1. There you go. Zeitgeist, maybe that's just at the moment, though, if you kind of get the joke. Have you got... Oh, no, don't worry, I was going to ask what a favourite word is. Never mind. Republican presidential candidate Donald Trump says he will end the double taxation of US citizens living abroad if he wins the presidential election. More tax cuts, as he urged overseas voters to register to vote. The US tax system requires Americans living or travelling abroad to file tax returns in the same way as US residents. Exemptions and tax credits means the majority of Americans abroad do not pay tax, according to the Tax Foundation think tank. That's interesting. Unless they live in a country which does not have a tax treaty with the United States. Karen.
Interesting working of the demographics before the election and for key votes. Now, UK Chancellor Rachel Reeves may need to raise £25 billion in tax revenue in her first budget if she wants to meet her pledge to grow public spending as a share of national income, according to a report from the Institute for Fiscal Studies. Prime Minister Keir Starmer refused to rule out hiking employer national insurance contributions when questioned by Rishi Sunak at Prime Minister's questions, instead repeating his commitment to not raise tax on working people.
We're working people.
We are.
Are you a working person?
Apparently, I tend to turn up at
What is this
4 o'clock in the morning for a little bit of work.
Where are we, in 1930s? Where there's lower, middle and upper?
Exactly.
I mean, we're all middle class now, aren't we?
We just draw a circle around certain people.
When do we become not working people? Keir Starmer, sir. Keir Starmer, tell me when I become a not working person. I've been getting up at 3 o'clock for the last 25 years. Am I a working person? I've got a load of old nonsense working people is.
So that your pension could be in sight as well.
Well, what? Because I've worked hard and put money in my pension?
Exactly. Well, the Resolution Foundation has estimated that levelling national insurance on employer pension contributions could raise up to £18 billion by 2030. Former UK Home Secretary James Cleverly has been knocked out of the race to become the next leader of the opposition Conservative Party in a surprise result which saw him lose ground after winning the previous round of voting. Former Business Secretary Kemi Badenoch and former Immigration Minister Robert Habeck, both seen as coming from the right of the party, will contest a vote of party members, with the final result due early
Well,
next
now we know, don't we? We know the Tories want to tack to the right to block off reform rather than tack to the centre to face the Labour government as well. That's pretty much the hard truth of it, and that's what the Labour members, the Conservative members will be voting on, I think we know, on November 2nd, don't we?
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Gumete, weekdays on CNBC.